Hello there, traders. Welcome to this webinar at binary.com. We'll be taking a look at trading breakouts.
To explain the risk disclaimer. Now, trading foreign exchange, trading futures, all of these global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this video and live webinar is for educational purposes only. So I do thank you for your attention on that. So, well, today's goal, we're going to take a look at all the ins and outs on trading breakouts, as I already said, but also avoiding false ones. And there are many false ones, and that makes, in a way, trading breakouts sometimes a bit more difficult, but it is also something of a very lucrative business if you understand what could have the potential of being a good breakout and what could be a false breakout. But before we can do that, we're going to, of course, explain what is a breakout, first of all, when to trade it, and how to trade it. So that's today's lineup. Now, if you're in the mood to type, I would be curious if you trade breakouts yourself. Have you ever heard of it, first of all? Do you trade it? What methods do you use for identifying the breakout? We'd love to hear from you and get some feedback about your thoughts about breakouts. Is this a totally new concept? Is this something you actively use and you're trying to sharpen your tools? Please let me know. Would be awesome to hear from you. You're going to get, of course, my version of the story, a bit more detailed, in fact. What are breakouts, first of all? A quick understanding of that. A breakout is when price pushes through a support or resistance. That's it. Support or resistance. Now, what that support or resistance is could be a lot of things. For me, it's fractals, which is an indicator of Bill Williams. It could be trend lines. It could be moving averages. That is what I typically use. Others could be using Bollinger Bands. You could use a lot of things there for determining support and resistance. But when I'm looking at breakouts, I'm looking at trend lines primarily, and fractals and moving averages. When price moves through that resistance or support, that means that that level is not important enough for the market to defend, and actually we're breaking out. And it's very important to realize that at any support or resistance, there's a likelihood for the price to bounce off that level. If there's a major top, for example, and I'll use a drawing tool here. If there's a major top and price is climbing up to that top, sellers would use that top as a resistance to take a position and speculate on downside, because they would think other traders are doing the same at that major top, at that major resistance. So when price approaches that major resistance, buyers would be more careful because they know there's a major resistance close by. Sellers would step in and the price reverts from the upside to the downside. That's why those support and resistance are so important. The opposite, of course, would be valid for a down move that approaches support. That's why they're so important, because price will often bounce off of support. Alright, I'll give you a schematic for the other side. We'll bounce off support usually, and we'll bounce off resistance when moving up. That is typical, but if it doesn't do that, it's a potential breakout. In most cases it is, and you're breaking above or below that potential support or resistance. Okay? Long positions are triggered when prices move above resistance, while shorts are, of course, when price goes below the support, right? Now, if this is all clear, just all please write down a yes so that we can, move a bit quicker. But I want to make sure that everything is clear, even if you're starting from scratch with breakouts. Obviously, the longer time frame, the higher time frame, I should say, the more significant the breakout will be. What that means is that if you have a resistance and a support, and price is between those levels for very long, and bouncing between them for quite a while, first of all, then a breakout already has more significance, but also the higher time frame, the better, in fact, because the more importance the breakout would mean for the market. Let me say it this way. While shorter time frames would have more impact on day trading. So I hope this is all clear for everyone. If not, please feel free to ask any questions at any time. Now what basically happens is this. Price consolidates at one level, which means consolidates means bouncing back and forth between resistance and support. Resistance and support. It's just bouncing back between those. Right? And if it then breaks out, that's when we get a momentum move, an impulse. Then price would go back into consolidation. And we do price with pink so that everything's clear. Then once it breaks out, eventually price will go back into consolidation and break out again. So it's a constant rhythm of breakouts, momentum impulses, corrections. Impulses, corrections. Right? This is actually the DNA or the heartbeat of the market. And in this case, it always moves from level to level. Price will go from one level to another, down to another level, go back to another level. And it does that continuously, up and down, but it does so in corrections, impulses, corrections, impulses, corrections, impulses. And these corrections are also often chart patterns, right? For example, this could be where I have the green line, this could be a triangle, this could be an expanding wedge, the first one could be a flag or a wedge, this could be a flag, as you can see. Those are chart patterns. Alright? Those chart patterns are often corrections. Good. So basically, a breakout occurs when we move out of that consolidation or range, as I already said before. A long time frame, well, I would consider anything 4 hour and longer long term. Now, of course, the weekly is very long term, 4 hour and day chart are semi long term, and 1 hour is already short intermediate, and anything below 1 hour is definitely short term. So what that means is that personally I trade 1 hour trend lines on the 1 hour chart, for example. Those are good stable trend lines on the 1 hour chart. There's nothing wrong with them. Trading 5 minute trend lines is definitely, less secure. 15 as well. There you'll have more false breakouts, and you will have to, it's more difficult to adapt to that market because it moves quite quick. And especially if you're looking at time frames, it will be difficult to estimate trades, which is important with binary.com. The time factor as well. While a 1 hour chart is easier, I think, to estimate that time factor. Here's an example of a 4 hour chart of the euro. You can see just by drawing trend lines, when price breaks out of that, that's when you get that up move. And you can see that price stopped at that trend line here, paused, and broke out later. Broke out. Broke out. Broke out. Right? And here we had a bounce, actually. We used that trend line to continue. So we're always breaking and bouncing. If you want to be more safer as a forex trader or any trader, you would only take breakouts in the same direction as the trend. That's the safest. But sometimes breakouts, counter trend or reversals or in ranges work as well, but they're definitely not as secure as with the trend breakouts. You can see that's just an example of trend lines. Now I use trend lines, but it doesn't mean that other tools wouldn't work well. But my primary indication is trend lines. So, as you probably already know now, the goal of this breakout is to establish whether prices can push through and continue with the trend or with the move, with the impulse, and whether the corrective price action has ended. And basically, when there's a false breakout, what happens is that there was enough momentum to push through it, through a certain resistance, or through a certain support. There was enough momentum, but once we pushed through, there was no sustainable continuation. And the price did in fact the opposite. And it went, for example, if let's take an up move example, when the price is moving up and pushes through the resistance, but then doesn't have the sufficient power to keep pushing through the resistance and then actually crashes. That is a false breakout. It did break out, but it didn't go as far as one would expect, just a tad through it, and then in fact doesn't continue. Alright? We'll talk about more about false breakouts later on though, and I'll explain a tip which you can use to avoid false breakouts. The other thing we use for breakout trades is basically the advantage of breakouts. I'm not sure if I mentioned it somewhere else, but the main advantage of trading breakouts, because there's a big advantage of it, is that however long the currency is consolidating and correcting and ranging and going sideways, once the currency breaks out, typically that's when the currency moves fast and quickly into the direction of our trade. What that means literally for our trading is that we catch the first moment that we think the currency is going to travel to our target in the fastest speed. That means it will move a lot of pips and it will move quickly. So when we have a breakout, you can, for example, aim for a trade that only lasts several hours. Alright, that you can do with binary. Once you have the breakout, there is that higher statistical probability that the currency will be above the breakout level within a short time frame, because it's going to move fast. So something like this could happen. You have an up move, you have a long, drawn out consolidation like this, and then once we break out, and I will show the resistance line with pink, there's a high chance that we'll move fast and far, just like the previous green line. The advantage of that is that we're not, as traders, we're not stuck in that red area. And that can take long. Either you lose the trade if you're trading plain vanilla trading, or if you're trading options, binary options, then you'll lose the trade. If you're trading plain vanilla, you could be stuck in that trade for long, and you're not able to trade any other opportunities in the market, right? Your confidence will decrease as well. The psychology will be annoying, and you might get out of the trade right at the end, and then eventually, actually, right at the moment that you close the trade, you see the trade going your way. How many traders have that? A lot of them. All right. That's because they enter at the wrong moment, when the currency is actually topping out, ready to make a consolidation, and they exit right at the end of the consolidation. While in fact, traders should be doing the opposite. They should be waiting for the consolidation to finish, and trading it when the consolidation is finished, trading the next move, basically. Because instead of waiting, maybe that red zone is 24 hours, maybe it's 4 days, depending on your time frame, and the green could be 1/4 of that time. And obviously, this is moving up 20 points, up and down, while the green could be flying up 80 points. That is the main benefit of breakout trading. There are other level ways of trading as well. As you know, you could, for example, trade certain levels or certain confirmations like price action, but those give less they don't have the optimal timing when the currency is ready for that big move. Sometimes they do, but not always. That's just always the advantage of a breakout. So basically, as I said, let's continue here. Types of breakouts: continuing with the trend, reversals or counter trend, and false breakouts. Here are some examples on the Euro-Dollar 4-hour chart. Those black boxes are ranges and consolidation zones. And when price pushes through them, like it did at the bottom here on the left, where I'll have a green line here, up move, sideways move, breakout continuation, sideways move, breakout continuation. Huge, massive box doesn't get upside continuation, but in fact moves down. Counter trend breakout. But then does find support and moves up again. Now we get the same big old black box, but this time we do get continuation breakouts. Another sideways move, continuation breakout. Sideways move, continuation breakout. Alright. So that's what we're looking at. Now I hope everything is clear so far. We're now going to take a look at different types of breakout trades. Because there are different ways, once you have a breakout, for example with the trend, then there are different ways of trading that breakout. Alright, does everyone follow me on that one? So, you have a move up, and you get a consolidation like this, and we have the breakout. But how do you actually trade the actual breakout? When it is breaking, okay, it's good to know that we want to trade breakouts. Great, we're going to trade breakouts. We see the up move, we see the sideways move when it's moving up. Where do we actually, and how can you trade the breakout? And then there's a concept called the breakout pullback continuation, or the break pullback continuation, right in here, PBC. Who has or hasn't heard of PBC? Break pullback continuation. Yes or no? If you have, please type yes. If you have. If you haven't, please write N. No problems if you didn't, of course. This is not a quiz or something like that, or a test. Alright, so just for my feedback, so this PBC is a very good concept to know, because you can use it anywhere, in fact. Basically what happens is the currency, if it makes this move up, or any, I would assume any financial instrument, but as you know, I'm primarily focused on Forex, is you get this flag, the chart pattern, right? If you get a continuation after that, we're going to zoom into the factual breakout. So let's, remember I'll put that pink box here. So if we zoom into that moment on a lower time frame, we'll have often enough something like this, making lower lows and lower highs. And eventually when we break out, the currency is not going to continue with those lower lows, lower highs. Let's say this is the 1 hour chart on the left, and this is the 15-minute chart on the right. Or it could be day chart on the left and a 1 hour chart on the right. Doesn't really matter. The principle, the structure, the movement is the same. So instead of making higher highs, higher lows, the currency is going to, or the product is going to push through that resistance. And when it does that, That's the break. The actual break is when the currency pushes through the last resistance to make a higher high. That's the actual break. That's part one, the break. Then it depends how far the break goes, right? But the pullback is after the breakout happens. You'll get eventually price will move down a bit and pull back, often enough to the same breakout level. Could be the support level now, and price will bounce off of that pullback. All right. So the traders who are trading pullback could use, for example, that as their entry. That's option number two. The breakout, the actual first breakout, a few points above the last high in an uptrend, right, would be the first one. That's the break. We put a B there. The P is the second one. And the continuation is when you get a second bounce and continue. And the continuation would be with the second newer high. And there would be the C. So all three are type of breakout trades. The first one is a breakout, the second one is a pullback breakout, and the third is a continuation breakout. All of them are trading the breakout. You're trading the 1 hour breakout, but we're now talking about the 15-minute or lower time frame entry methodology using either the actual break, pullback, or continuation, or maybe a combination. You could also easily use different time frames, right? You could use, for example, the trend line on a 4-hour chart and use the break, pullback, continuation entry methodology for the 1 hour chart. The 1 hour and 15-minute world was just an example, of course. Now mind you, everyone would need to practice this because it will take experience, a lot of, viewing and understanding of the market to know which may be better. That's not an easy thing to explain in 1 hour, unfortunately. That's just the fact of life. But now that you know this concept, which is basically the DNA of the market, that's just how it moves, and the rhythm, right? Then you will understand that when the currency is pushing through a resistance, it does mean, a very important thing. Also mind you that multiple time frame analysis is important as well, because when you're in fact looking at lower lows and lower highs, for example here, let's say that this is the 4-hour chart, you're making upside, and the currency is correcting like this on a lower time frame. The 4-hour chart, this is the 4-hour world, is obviously an uptrend, but if we zoom into a lower time frame, we have some smaller downside momentum. So if we zoom into 1 hour chart, you would see lower lows, lower highs. While on the 4-hour chart, it would be obvious that the downside is highly likelihood of just a stall or pause. So when on the 1 hour chart you're breaking above that resistance, you know that the likelihood of a breakout and the continuation of that 4-hour uptrend is high. Trigger happy traders or trades is in fact taking the breakout. Why is that that is a bit more riskier, because you're in fact not waiting for any pullback. And usually the market always makes a retracement. Well, not always, but in most cases there's always a retracement. And planning for the retracement is safer. But sometimes the power in the market is so big that taking the breakout makes more sense, because the currency just blasts away and continues and continues. Alrighty. Now false breakouts. You might be interested about that. Once again, if you have any questions, let me know. No problem at all. False breakouts are those black circles there, where the price breaks through a certain resistance, but doesn't get any follow through. No follow through. No follow through. You see 3 examples there. There were breakouts, but price was pushed above the resistance and then went easily back underneath. Price action candlestick formation patterns. Alright, Japanese candlesticks are very, very good in giving an idea that there could be a false breakout. And one of those signals is if you have, for example, a big wick. I don't know if you can see it. I'll zoom in a bit. Can you see this wick right in here? And here? Engulfing twins on the right. This one was not that noticeable. It's not always a guarantee that you'll avoid every single false breakout, of course. But today, in my trading, for example, I took an odd yen long and I closed upon that. Now with binary options, you cannot close a trade because you're time dependent. But if you do see a signal like that, you could take preventive actions by taking, for example, a trade to the opposite direction, in a way hedging yourself. Alright, so by using that you can see if the price is sustainable or not. If there's big wick on top, that's not good, right? And in fact, it's not always, of course, the case that the big wick will lead to a reversal. Once again, here's a big wick, and the currency just continues. But it's specifically when we have a breakout, that there could be an increased statistical probability that there will be either a bigger stall or a bigger reversal before continuing. But it's not always the case. That would be probably the number one. But also, by the way, let me see if, yeah, if you have a oscillator like the Awesome Oscillator, I think we had a webinar here at binary.com about that. And there is a divergence between tops and or bottoms. That would also be another indicator to give an idea there could be a false breakout. Alright. Also, if the oscillator hasn't returned to the zero line yet, for those of you who've watched that webinar, that could be another method. When to trade breakouts. If you're trading within the day, then the best is London Open and New York Open. A lot of movements happen within those sessions. And for breakout trades to be sustainable and have a good impact on your trading, you need that volatility. If you're trading a range, there's nothing wrong with trading necessarily other times, although these movements are very small. So for binary trading, I would not recommend it to trade between, for example, the end of New York and Asian Open where nothing happens, for example. That's just the time where there is no movement. And the chances of the currency then being above your entry 2 hours later or even below it is just, there's not much statistical edge you have. And you want to have a statistical edge, or probably none at all. And you need that statistical edge to be profitable. There are certain times like Asian and New York afternoon that you could look into range trading, for example, but with the trend, breakout trades is best with London Open and New York Open. The first 3 hours, 4 hours of that. New York afternoon sometimes is possible as well, but less movements than the ones I just mentioned. All right, but New York afternoon would be a good third, and Asian would be the number fourth. So, a summary here on what we could expect of opportunities and dangers. Now, as I said, it's a faster way of making profit. And that's important because just like companies want to get their goods sold as fast as possible and their money collection done as fast as possible, and maybe pay their payments as late as possible, right? I mean, that's just how it goes. um, we're kind of the same. We want our money as fast as possible back, and maybe with the least risk, right? So preferably. So breakouts do give that potential. Sometimes price, when it breaks out, can move up fast, huge momentum. And why is that? Well, often enough, the market will have, for example, when you're in a certain movement like this and making lower lows and lower highs, if price breaks above the last resistance, where do you think traders are keeping their stop loss, their protective stop loss against a trade not developing? Right above resistance or right below support. And that's a good thing. It's not bad. Everyone should do that if you're trading plain vanilla trades. That's where your stop loss should be. With binary options, you don't need stop losses. You have a time stop. But if you're trading plain vanilla, that's where the stop losses would be. And that's a good thing, by the way, because that's technically correct. I'm just explaining that once price pushes through that level, it triggers more or fuels more upside or downside. In this case, upside, because that's where stop losses would be kept, and when stop losses are triggered in this case, then you get buying reactions. So there's buying, right? Just explaining, because even though you're looking maybe at a binary option trade, the price movement is of course caused by the spot price. The breakouts, depending on the time frame, on the 5-minute world, will typically be 10 to 25 pips. And what I mean with we're always buying into resistance is that, technically speaking, when you have that correction, for example, if you have something like that and you place a trend line on the top, that didn't work out. Let me redraw that, what I wanted to show you. When you're in a downtrend like this, and you're breaking out of a trend line specifically, now I'm talking about the trend lines. So you have a trend line that connects the tops and you're breaking out of that, then when you're trading the breakout, in fact, you're still at one point in time still trading it right in front of the next resistance. So you're assuming the price will break through that resistance on the lower time frame. And that's okay. That assumption is fine. As long as you're trading something like this. We redraw that. If you're trading something like this, and then taking that breakout, then even if you're taking it just a bit before the resistance that I have, let me draw that. I'm running out of colors. I'll do orange. Do I have orange? Yes, I do. So even though there's an orange resistance there, and you can see, take a look at the green. When does the green go to the pink? It goes through the pink, through that trend line, which is also resistance, before it breaks through that orange, the horizontal resistance. So that's what I mean with you're buying into resistance. You're buying the breakout of the trend line, but you still have horizontal resistance left. That's okay because you have that huge impulse and momentum on the left, the green up move. So you're kind of assuming that resistance, that shorter term resistance, will crack and break, and that's okay. The opposite would be true for support. Right? That's trading breakouts, but that's why some wait for the break of the orange line and then the hook back, the pullback, right? We talked about it, and trade the pullback or continuation. That's why that is safer than trading the break of the breakout. I hope that makes sense. Right? That's why this is the B, that's the P, there's the C. That's why the B part is more risky. The P and the C is safer. But usually if you have a move like that, it does break. But it's good to know about it. let's see. Now, trading breakouts in a ranging market is definitely more difficult than in a trending market. And in fact, you should always start with trading it in the trending market. And if you're successful with that, then maybe you can take a look at others. But it's possible. It's just requires a bit more experience. But it's possible. False breakouts are quite common, so we have to keep an eye on that. All right. So I already told you about that. All right. The rest we talked about. Good, so here's an example of the chart. 4-hour chart, pound dollar. What do we see here? Those black boxes, of course, indicating those corrections. And the down move indicating the impulse, with the trend move. Because does everyone see here, we're making lower lows, lower highs here. All right, you can see it. Where I have the circles. So everything to the downside is with the trend. Sideways, stall, pause, continuation, pause, continuation, pause, continuation. There's one example though where we got the opposite. It's the very last example where we got a pause, but the currency broke to the opposite side. That's a counter trend reversal breakout, and those are definitely more risky. The rest broke with the trend. So we talked about this already. In fact, divergence is very important to check that as well. If there is divergence, the breakout may not be sustainable. And it's also good to check maybe the volatility and the momentum. And of course, the more power and momentum there is, the more strength there is with the breakout, and the higher the chances are that there will be a sustainable breakout. Now, some indication of what that momentum reading, how you can measure momentum, I'm going to give you right now. You can measure the strength of momentum, for example, by using a moving average. I use exceptional moving averages. By using a short-term moving average, like for example 12-period exceptional moving average, or EMA for short, the angle of that moving average will indicate the potential power of that move. Bollinger Bands as well. I don't use them myself, but just give you all the details. As I said, price action, something I highly use, definitely recommend that. But also the consolidation zone length. Alright, you see, that is maybe a bit tricky, but it's actually very important for binary trading, is when you have a move up and the consolidation correction is taking too long, then in fact the chances of that breakout occurring are decreasing. But the longer the better is not totally true. In fact, I should correct that. What I meant with the fact is that if you have a decent size, an optimal size, you will get a very good breakout. That's what I meant. But if it's too long, it will turn into the opposite, and it will become a downtrend potentially. All right. If it's too short, well, it could still be a good breakout, but there is a chance of that becoming a false breakout. Those chances are higher if it's too short. Or if it does continue, it could reverse pretty quickly. All right, if it's too short. There's an optimal time level, and that is going to be very difficult to explain because that's actually a totally different topic, unfortunately. But I can give you a rough guideline. If you look at the candles, if you're looking at, for example, not move. And you're looking at a bull flag here. And this is the 1 hour chart. Zoom out one time frame. Alright? One time frame. So that would be the 4 hour chart. If you're on the 50-minute chart, go to the 1 hour chart. If you're on the 4 hour chart, go to the day chart. Alright? 1 hour chart, go to the 4 hour chart. And look at the candle that has the highest high of that move. And count how many candles are next to the candle with the highest high. So if I put the candles on the chart here, we have an up candle, up candle, up candle. The next one is the highest high. And count how many candles are to the right of it. If there are 4 or 5 candles, that's okay. If there are more than 5, then the likelihood of a break is decreasing. But especially if it's, if it's more than 5, up to 5 is okay. If there's 1 or 2, it's on the short side. 3, 4, 5 is about optimal. Alright? So that you have an idea. This is kind of a shortcut in a way. Or if you use trend lines, if you're active in trend lines, often enough, a trend line with 3 hits is the best. And if it has more, 4 is okay, but if it has more trend line hits, then in fact the whole period is becoming too long probably. As I said, it's a bit difficult to explain in a minute, time factor tips. It really would deserve, I think we already had a separate webinar on that. It would really deserve, a full session in fact. If you would have interest again in that, let me know. I think we have a recording. I'm not 100% sure. This is an example of the moving averages. And you can see the angle of, for example, the 5 and 20 EMA. And when the 5 with this candle, sorry about that, when this 5 minute candle closes, you can see the 5 EMA very strongly pointed to the upside. The price stays above that 5 EMA and it makes an impulsive move. And for the downside, it's the same right in here. When we break out below, alright, you can, for example, draw a trend line like this on the chart. You can see when price pushes through that level, the 5 EMA is also at a very steep angle. Bollinger Bands, for example, here are examples. When price breaks out, it's not touching the Bollinger Band. And when it doesn't, that means there's still space to the Bollinger Band. That's good for a breakout. But if it is touching, like here, price is touching the Bollinger Bands, then those breakouts do not go far. Once again, this is not a tool I actively use. So this is just an example of a Bollinger Band that I randomly chose. It's not something I actively have experience with, or could say that this happens often. I don't know. I just know in theory Bollinger Bands could be something that is used to measure that. I have more experience with moving averages with that confirmation, and I think those work well. Okay, Bollinger Bands I'm sure work well as well, or at least I think would work well as well, but I don't have that experience because I use other tools. But I do want to mention that that could be a potential tool. I already talked about chart patterns, in fact. Right? Double and triple top, rising and falling wedges, headed shoulders, inverted headed shoulders, flags, triangles, what else did I miss? Those are the basic ones, right? Bull flag, bear flag. Also, very important is trading in liquid times. When you have, for example, a major news event going on, if the non-farm payroll is being announced or released 1 hour from now, then the chances of a breakout or sustainable breakout are absolutely zilch. No one is in the market, no one is going to move the market, everyone's waiting. It's a waiting game for that news event. Same if there's a public holiday in the US, in the UK, or the majority of all Europe, right? And if Japan has a bank holiday, then the Asian session would not probably move as much. And if the US and UK have both a holiday, don't look at the charts because there's not going to be any movement. Alright, so obvious times of illiquidity, just do not trade breakouts, or maybe not trade at all, because there's not going to be anything to do. And by the way, the first 2 weeks of January and the last 2 weeks of December are always a bit more difficult to trade. Just like trading in August, the key summer month is always more choppy, and breakouts will be less sustainable. All right. Well, that went actually faster than I expected, which is good. So it gives us some time for some Q&A if you want. Please feel free to ask anything you want. In the meantime, if I can have 1 minute of your attention though, just wanted to give you a heads up of something we do at Binary.com. And that's just a live market commentary. Pure and simple. We have it every Monday. So if you want to join us live, it's possible. I make it quick and precise. We look at technical analysis. We use trend lines, breakouts, moving averages, Fibonacci, and time factor, oscillators, all these things in a real live environment though. Not in theory or behind the fact. We look at the market in front of us. And you'll get a heads up how I think about the current market movement or in other words, structure. Now, of course, that's free. And from September 30, I will actually be adding more fibs and elliott waves on the chart. It's next week, Monday. It's 20 to 30 minutes. And we're looking at the Forex market. And next USD, as I said, it's live at 7 a.m. London, or 8 a.m. Central European Time, 6 a.m. GMT. It's recorded as well, and if you want a heads up of that recording, that would make sense. You can watch it anytime you want. Just go to blog.binary.com/weekly trading room. You can watch it anytime. Try to keep it within 20 minutes. I know everyone's time is precious. And you'll get a good heads up what could be expected for that week. Because most of the time, there's only 1 or 2 key movements in a week. Look at last week. FOMC was released. The Fed said no tapering. What did you get? A huge up move of momentum on the euro dollar, for example. Otherwise, except that up move, the euro dollar did nothing. That was the move of the week. So let me show you what happened with the euro dollar. It went flat. FOMC, well, not totally flat, but it moved like this, minimal up and down. This. FOMC came, went up a lot, and then started to make this correction. That was last week's price action. So often enough, the weekly heads up gives a good indication. So that's blog.binary.com/weekly trading room. All we need is your name and email address, and you'll get a heads up when the recording is ready for viewing. But you can visit the live session as well. I encourage that. In fact, I'll give away an indicator for everyone free indicator, very cool indicator, for anyone who joins the live session in September or October. So, any questions still? Let me leave that link maybe here so you can write that down, in fact. Any questions? Does it make sense? Do you like it? Do you like breakouts? Or do you realize that you rather trade something else? Is it piquing your interest and you're thinking, might want to trade that? Or was it already something you traded? Or were looking into trading? All right, cool. Got someone who's interested in that. That's very interesting. In fact, it's to be honest with you, it's actually all traders are kind of looking at this. Some of them, some of you, some of us might not know about it. Currency, in fact, is always doing this pattern and rhythm, and we can ignore it or choose to, accept its reality and try to use that information. I think using that information makes sense personally, because it will give you that wisdom. But like anything, it does require time and experience to get better at it. But if you, with this knowledge, it's not a specific strategy, but of course it's a method of looking and understanding the market, which will give you a better feeling for which strategies might work at particular times and which not. And that will help in the long run. So I'm glad that you find it interesting, Mark, and definitely would encourage you to view this and look at these concepts on the charts, in fact. Yes, Sarah, there will be a recording, so that's no problem at all. You should be able to watch that. And then I have a last question for you. What topics would you like to learn about more? I think a few weeks from now we'll have a webinar on specific strategy. All right, so that could be interesting for you as well. I think we're looking to a specific strategy. This is basically understanding the market in a way. So we made it a bit broader topic than specific breakout. It ties into each other so quickly. The opposite of a breakout, by the way, is a bounce. If the currency is moving up like this and we're correcting like this, and there's a big trend line, for example, like this, that connects bottoms. Something like this. Then, for example, if the price corrects to that line and hits it and moves up from there, that in fact, where I have the green box, is a bounce off that pink line. All right, that's a bounce. When we actually don't break, we're bouncing. By the way, I forgot about that, to mention that. And yeah, that's just, you'll see this everywhere on all time frames. Currencies will be going from one resistance to another, one support to another. Alrighty, folks. Well, if you have any specific topics, let me know. Otherwise, we're going to wrap it up, and I'm going to wish you a great trading week and weeks ahead, and we will be talking soon. When we have the next webinar. The measurements, the tools you would have the software. Well, you would have to go to a Forex data provider, a Forex broker, for example, or a third-party data supplier. Binary.com, we have charts, but I don't think they have some of the tools that we mentioned here. So you would have to go to, to one of those. So if you wanted some tips on that, what I can do is send you my email address, and just send a message, hi, can you send me more information, and I would do that. Okay, the ad, of course, is Snail. Alrighty. Thanks so much, everyone, for being here again, and wishing you all a great week. Cheers, everyone.